In Chapter 6, we are going to discuss characteristics and evaluation of two sources of long-term funds that a firm uses to raise its long-term capital. Long-term sources of funds include fixed income securities and common stock. Fixed income securities consist of long-term debt and preferred stock. The term fixed income security is from the perspective of security holders because, in general, holders of these securities are promised to get fixed payment in return for their investment. There are three major differences between long-term debt and preferred stocks. From the perspective of the borrowing firm, the interest paid to long-term debt security holders is a tax-deductible expenses, where dividends paid to preferred stockholders are not. Long-term debt holders are considered creditors, where preferred stockholders are considered owners. The failure to meet interest payment and principal repayment leads to a more serious consequence. Long-term debt normally has a specific maturity, whereas preferred stock is often perpetual. A long-term debt security has an indenture which thoroughly details nature of debt issue, carefully specifies manner in which principal must be repaid, and lists any restrictions placed on firm by lenders. Here are some lists of typical restricted covenants. There is a trustee representing the debt holders to ensure that the issuing firm of a long-term debt issue adheres to terms and conditions set forth in the indenture. A callable bond is a corporate bond with a call feature that permits the issuing firm to redeem or call a debt issue prior to its maturity date at a specified price, termed redemption price or call price. The call price is greater than the par value of the bond, and the difference between these two is termed call premium. Many bonds may not be callable for several years after the initial issue date, and this situation is referred to as a deferred call. Many firms issue bonds with the call feature because it allows firms to exploit the lower financing cost if market prevailing interest rates decline. That is, the issuing firm has the flexibility to retire the debt issue prior to its maturity date if the market prevailing interest rates are lower than the interest rate specified at the time of original issue. The action that a firm calls a relatively high interest rate issue and replace it with a lower interest rate issue is called bond refunding. Lenders often require that a borrowing firm gradually reduce the outstanding balance of a debt over its life. The usual method of providing for a gradual retirement is a sinking fund, which is a certain amount of money put aside annually to help repay a bond issue. Some debt issues are linked to the equity of the firm through a conversion feature that allows the holder to exchange the security for the company's common stock at the option of the holder. The coupon rates on new bonds are normally fixed and set equal to interest rates on bonds of comparable quality and maturity, so that the bonds sell at or near the par value. Original issue deep discount bonds have coupon rates below prevailing market interest rates at the time of issue and therefore sell at a discount from the par value. Zero coupon bonds have no interest payments and therefore are original issue deep discount bonds. The typical maturity on long-term debt ranges from 20 to 30 years. Bonds with the feature that permits bondholders to ask issuing firms to redeem bond issues at par value prior to the maturity date are called extendable notes, or put bonds. The column coupon indicates the annual coupon rate associated with the bond issue. The column last price indicates the price quoted as a percentage of the par value. The price quote 98.587 means the price is indeed 98.587% of the par value. That is 98.587% times $1,000 equal to $985.87. The column last yield means the yield to maturity. It indicates the annual rate of return investors can expect to receive if the bond is purchased at the last price quoted and is held to maturity. The column EST spread provides the information of the default risk spread, defined as the difference between the yield to maturity of the corporate bond and the yield to maturity of the Treasury bond having the same time to maturity. It's called the default risk spread because it gives the extra rate of return that investors require to compensate them for the potential default risk from holding the corporate bond. U.S. Treasury bills have an initial maturity of 13, 26, or 52 weeks. They have no coupon payment, therefore, they are sold at a discount from the maturity value, $10,000. This table is an example of a typical Treasury bill quote. It was quoted on March 26, 2010. It would mature on October 21, 2010, or in 219 days. The last column, asked yield, is the annualized yield an investor will receive by purchasing this bill and holding it to maturity. The asked bid quote represents the annualized percentage discount from the maturity value. The asked quote of 2.4 indicates an annualized asked discount of 2.4% from the maturity value. The equivalent cash discount value is calculated as the approximate proportionate discount, which is 2.4% times 219 divided by 365 times $10,000 equal to $144. Therefore, the asked price is $10,000 less the cash discount value, $144, equal to $9,856. If you are an investor would like to buy Treasury bills, you will look at the ask quote. And if you would like to sell the Treasury bills you have, you would look at the bid quote. Treasury notes typically have an initial maturity between 1 and 10 years. Treasury bonds typically have an initial maturity ranging from 10 to 30 years. They typically pay coupon payments semi-annually. They are issued in denominations of multiples of $10,000. Their prices vary in units of 1/32 of 1% of par value. An X price quote of 94:17 means the bond sells for 94 and 17/32% of par value, that is 94 17/32% times $1,000 equal to $945.31. Debt issues are rated according to their relative degree of default risk by independent agencies such as Moody's and S&P Corporation. This table shows the relationship between S&P's bond ratings and bond yields. For any maturity, the higher the bond ratings, the lower the bond yields are. That is, for any maturity, there is an inverse relationship between yields and the ratings. The difference between a 5-year AAA bond yield and a 25-year AAA bond yield is 0.38%, and the difference between a 5-year Treasury yield and a 25-year Treasury yield is 0.08%. That is, the maturity risk premium is larger for industrial bonds than it is for T-bonds. From the issuing firm's perspective, advantages of using long-term debt include: first, it has relatively low after-tax cost because the interest paid to long-term debt security holders is a tax-deductible expense. Second, it may increase earnings per share through financial leverage. The reason is that when calculating earnings per share, possible increased earnings are not diluted through enlarged number of shares outstanding. That is, the number of shares outstanding remains constant. Third, it lets firm's owners maintain greater control over the firm. Again, the reason is that by using the long-term debt financing, the firm does not bring more new owners. From the issuing firm's perspective, disadvantages include the increased financial risk of the firm resulting from the use of debt and the restrictions placed on the firm by the lenders. We are going to discuss how bonds are valued. The valuation is a straightforward application of finding out the present value of future cash flows specified in the contract. By looking at this figure, we can find that by holding a corporate bond, you are entitled to receive a stream of interest at the end of each period, that is, an ordinary annuity up to the maturity date and a maturity value on the maturity date. Therefore, the value of a bond is in fact the present value of an ordinary annuity, that is, the present value of the interest plus the present value of the maturity value. The interest payment. The annual interest payments are calculated by the annual coupon rate times the par value, that is, the face value of a bond. The par value of a bond is $1,000 unless otherwise specified. The maturity value is the principal payment, that is, the face value of a bond, which is equal to $1,000. KD is the investor's required rate of return. Find the present value of a 9% coupon bond with 20 years to maturity and $1,000 face value. Newly issued 20-year bonds are priced to yield 11%. Assume annual interest payments. Note the sentence, newly issued 20-year bonds are priced to yield 11% provides us with the information of the required rate of return. This is a time value of money problem. Let us first draw the cash flow timeline using the information given in the problem. We have equal annual cash flows, that is, annual interest of $90 for 20 years, and a maturity value, which is the face value of the bond, $1,000 at the end of year 20. We want to find out the present value of these future cash flows, that is, the bond price. We can solve the problem using the formula with the information provided. We can solve the problem using the financial calculator. The maturity value, $1,000, is input as future value. The annual interest, $90, is input as payment. The number of periods is the time to maturity, 20. The interest rate is the investor's required rate of return, 11%. Compute present value. Be cautious about the difference between coupon rate and the required return. Let us change the required rate of return from 11% to 7%. The bond price is then $1,211.46. When the required rate of return is 11%, larger than the coupon rate 9%, we have the bond price equal to $840.67, less than $1,000, the face value of the bond. When the required rate of return is 7%, less than the coupon rate 9%, we have the bond price equal to $1,211.46, larger than $1,000, the face value of the bond. What do we observe? If the bond promises you interest less than the interest you require, you would pay less than $1,000 to hold the bond because the bond does not provide you sufficient compensation to justify a $1,000 investment today. If the bond promises you interest equal to the interest you require, you would pay exactly $1,000 to hold the bond because the bond does provide you sufficient compensation to justify a $1,000 investment today. If the bond promises you interest greater than the interest you require, you would pay more than $1,000 to hold the bond because the bond provides you more compensation than a $1,000 investment today. This slide summarizes what we discussed about the bond price and the relationship between the required rate of return and the coupon rate. When the required rate of return is larger than the coupon rate, bond sells for less than the face value, that is, bond sells at a discount. When the required rate of return is smaller than the coupon rate, bond sells for more than the face value, that is, bond sells at a premium. When the required rate of return is exactly equal to the coupon rate, bond sells at the face value, that is, bond sells at par. Now, let us change the bond's maturity. Changing the bond maturity from 20 years to 10 years, we recalculate the bond price at the investor's required rate of return 11% and 7% respectively. Changing the bond's maturity from 20 years to 2 years, we recalculate the bond price at the investor's required rate of return 11% and 7% respectively. Graphing results from our earlier calculation, we observe that when the required rate of return changes from 11% to 7% for a 2-year bond, the price increases by the amount of $39.55. For a 10-year bond, the price increases by $258.15. For a 20-year bond, the price increases by the amount of $370.79. That is, the difference in the bond value increases as the maturity increases. In other words, low maturity bond prices are much more sensitive to interest rate changes. Investors who purchase a bond at the price determined by this equation and hold the bond until maturity will realize the required rate of return KD shown here. Investors may sell the bond prior to the maturity, and the market bond price may indeed decline due to a rise in the prevailing market interest rate. Therefore, investors may indeed earn less than the required rate of return KD. This is known as interest rate risk. Also, even if investors hold the bond until maturity, investors may have to reinvest the principal at a lower coupon rate once the bond matures and there is a decline in the prevailing market interest rate. This is known as reinvestment rate risk. This slide gives you information about how to use the annual information you have to calculate the bond value if the bond pays interest semi-annually. For annual coupon payments, N represents the number of years to maturity. For semi-annual coupon payments, the number of periods to maturity becomes 2 times N. For annual coupon payments, KD represents the investor's required rate of return per year. For semi-annual coupon payments, the investor's required rate of return per period becomes KD divided by 2. For annual coupon payments, I represents the annual interest, the annual coupon payment. For semi-annual coupon payments, the interest paid per period becomes I divided by 2. Continued from our earlier example, we show the corresponding value input into the financial calculator when the bond pays the interest semi-annually instead of annually, and becomes 2 multiplies the time to maturity 20 years equal to 40. The interest rate becomes the investor's annual required rate of return divided by 2 equal to 5.5%. The interest payment becomes the annual coupon payments divided by 2 equal to $45. The future value, the maturity value, is $1,000 unchanged. Perpetual bonds are bonds paying interest indefinitely. The value of a perpetual bond is then the present value of a perpetuity, with the perpetual annuity being the amount of interest and the discount rate being the investor's required rate of return. That is, the value of a perpetual bond is given by this formula. Now, instead of finding the value of a bond given the investor's required rate of return, we may indeed would like to find out the investor's required rate of return, that is, yield to maturity given the price of the bond. That is, we would like to solve KD for this equation. You can certainly solve KD by using a polynomial equation. However, to make your life easier, we are going to illustrate you to solve such a question by using a financial calculator in the next slide. What is the yield to maturity of an 8-year bond with $1,000 face value, a coupon rate of 5.125%, and a market price of $962.50. Assume the interest is paid annually. To find out the yield to maturity, we can ask the financial calculator to solve the interest rate for us. The corresponding values input into the financial calculator to solve the interest rate are N equal to the time to maturity, 8 years. The present value is the price of the bond, equal to $962.50. Be careful, you have to input the price as a cash outflow, and it does make sense because you pay that price to get the bond. Payment is the annual coupon payment calculated by the annual coupon rate 5.125% times the face value of the bond $1,000 equal to $51.25. Future value is the maturity value of the bond, that is the face value of the bond, equal to $1,000. Compute interest rate. The interest rate obtained is the yield to maturity. What is the yield to maturity of a 12-year bond with $1,000 face value, a coupon rate of 5.125%, and a market price of $962.50? Assume the interest is paid semi-annually. The corresponding values input into the financial calculator to solve the interest rate are N is equal to 2 multiplies the time to maturity 12 years equal to 24. The present value is the market price of the bond equal to $962.50. We have to input the present value as a cash outflow. Payment is the semi-annual interest payment equal to the annual coupon payment divided by 2, which is calculated by the face value of the bond, $1,000, times the annual coupon rate, 5.125% divided by 2. The future value is the maturity value of the bond, that is the face value of the bond, equal to $1,000. Compute interest rate. We have to multiply the interest rate obtained by 2 to get the yield to maturity, because we quote the yield to maturity on an annual basis. Yield to call means the yield or required rate of return investors would receive if investors buy the bond at the price determined by this equation and hold it till the bond is called. Determine the yield to call of an LTV bond with a 14% coupon that pays interest annually. The bond can be called in 7 years, has a call premium of $140, and is currently selling for $1,154. The corresponding values input into the financial calculator to solve the interest rate are: N is equal to the number of years till the bond is called, equal to 7 years. The present value is the market price of the bond, equal to $1,154. We have to input this value as a cash outflow. The payment is the annual coupon payment calculated by the annual coupon rate 14% times the face value of the bond, $1,000, equal to $140. The future value is the call price calculated by the face value of the bond, $1,000, plus the call premium, $140, equal to $1,140. Compute interest rate. The interest rate obtained is the yield to call. The yield to maturity of zero coupon bonds can be calculated by using this formula, or it can be calculated by using the financial calculator. Yield to maturity of perpetual bonds can be easily calculated by the formula presented here. Current yield, calculated by the annual coupon payment divided by the market price, is just an approximation for the yield to maturity. A change in the current yield always signals change in the same directions as the yield to maturity. Now, we want to work on the end of chapter question, question number 4. We have to find out the bond value, which is equal to the present value of all future cash flows. For this particular problem, the interest payments are adjusted every 5 years. We summarize the cash flow information here. The present value of all future cash flows can be easily calculated using the built-in cash flow worksheet function by TIBA2 Plus or TIBA2 Plus Professional. The detailed input values and steps are provided here. Here is the detailed explanation for steps implemented above. Note: net present value obtained is the present value of all future cash flows because zero cash flow at the current period is used in the calculation. We now would like to briefly discuss inflation and interest rates. Nominal rates are rates that have not been adjusted for inflation, whereas real rates are rates that have been adjusted for inflation. When economic agents make decisions, they base their decisions on expectations of real purchasing power, not on the raw dollar amounts they receive in the future. Therefore, we must make a distinction between nominal rates and real rates. You offer a $100 loan with 5% interest rate for 1 year. You will receive $105 when the loan matures 1 year later. Suppose the inflation rate is 0. It will allow you to buy 5% more stuff. Suppose the inflation rate ends up at 5%. You will get nothing more for your patience because everything will cost 5% more. Suppose the inflation rate ends up at 10%. You will be actually worse off because everything will cost 10% more. The Fisher equation relates nominal rates to real interest rates via the market's expectation of inflation. From the Fisher equation, we can obtain the real rates expressed by the formula presented here and nominal rates expressed by the formula presented here. Assuming that you wish 5% increase in real purchasing power, and you expect the inflation rate to be 4%, using the Fisher equation, we see that you should charge 9.2% interest rate. The term structure of interest rates, the yield curve, describes the relationship between the yield to maturity and maturity of bonds with the same risk. The upward sloping yield curve is considered a normal yield curve. Treasury inflation-protected securities, or TIPS, provide protection against inflation. You buy a 2-year 10% bond at its face value. What will be your nominal return over the 2 years if inflation is 4% in the first year and 6% in the second year? What will be your real return? Your nominal return will be 1 plus 10% times 1 plus 10% minus 1 equal to 21% over the 2 years. Your real return is calculated by the inflation-adjusted real return in the first year times the inflation-adjusted real return in the second year minus 1 equal to 9.76% over the 2 years. You buy a 2-year 10% bond at its face value. Now, suppose that bond is a TIPS. What will be your nominal return over the 2 years if inflation is 4% in the first year and 6% in the second year? What will be your real return? With the TIPS, the real return will remain at 10% per year or 21% over the 2 years. The nominal return on the TIPS is calculated by 1 plus nominal return in the first year calculated using the Fisher equation times 1 plus nominal return in the second year calculated by using the Fisher equation minus 1 equal to 33.39%. We are going to discuss characteristics and valuation of preferred stocks. The selling price, or the issue price, is the per share price at which preferred stock shares are sold to the public. The par value is the value assigned to the preferred stock by the issuing company. They are frequently the same, but no relationship necessarily exists. Cumulative feature means that a firm cannot pay dividends on its common stocks until it has satisfied all or a pre-specified amount of preferred dividends overdue. Non-participation means preferred shareholders do not share in any increased earnings. A preferred stock with the call feature permits the issuing firm to redeem or call the preferred stock at some specified price. Preferred stockholders are not entitled to vote for the company's board of directors. However, if a company omits its preferred dividends or incurs losses for a period of time, the preferred stockholders often vote as a separate group to elect one or more members of the company's board of directors so that the preferred stockholders will have direct representation on the board to protect their own rights. From the issuing firm's perspective, the main advantage of preferred stock is that the preferred dividend payments are potentially flexible. Missing a preferred dividend does not trigger delinquency like missing an interest payment on the long-term debt. From the issuing firm's perspective, the major disadvantage of the preferred stock is its high after-tax cost as compared with the long-term debt, because dividends are not tax-deductible, but the interest paid to the long-term debt security holders is a tax-deductible expense. For a preferred stock with no maturity and a constant dividend DP, the price of the preferred stock is the present value of a perpetuity DP. That is, the price of the preferred stock is calculated by the constant dividend DP divided by the preferred shareholders' required rate of return KP. Example: A&M pays an annual rate of interest on its $4.50 Series B cumulative preferred stock issue. What is the value of this stock to an investor who requires an 8% annual rate of return on this investment? The statement, annual rate of interest on its $4.50 Series B cumulative preferred stock issue, indicates the constant dividend for this preferred stock is $4.50. The price of the preferred stock is calculated by the constant dividend DP $4.50 divided by the preferred shareholders' required rate of return 8% equal to $56.25. Let's work on the end of chapter questions, question number 18. We are required to find the expected maximum price of the preferred stock. We first summarize the information of the relevant cash flows and draw the cash flow timeline. By holding this 5-year preferred stock, an investor is expected to receive the constant annual dividend payment of 84 cents for 5 years. An investor will also receive a maturity value when the preferred stock matures in 5 years. At that time, holders of the stock will receive at their option either $10 or 1 share of a common stock with the value up to $14. That is, the maximum maturity value can be expected to be $14. Therefore, the maximum value for which this share can be expected to be traded is the sum of the present value of the constant annual dividend payment of 84 cents for 5 years, that is, the present value of the ordinary annuity of 84 cents for 5 years, and the present value of the maximum maturity value. We can calculate the sum of these present values by using the formula presented here. It can also be calculated by using the financial calculator. The detailed input values are provided here.